Oh, the Fed's now thinking about raising rates in 2023 instead of 2024. The Fed doesn't know what's going to happen this fall. And my point is, with a forecasting record like that, why am I supposed to think you know what's going to happen in 2022, 2023, or 2024? This is about central bankers pretending to know what they're doing and pretending to have some influence when they actually don't. I've never seen a time where the actions and comments of the central bank mean less. The 10-year note, yield to maturity, that's a big deal. The price of gold, that's a big deal. Stock markets, they're all a big deal. Look at all the, if you want to waste time listening to the Fed, be my guest, but I don't. I guess I do. I mean, I'm aware of it. I analyze and I write all the time, so I have to I have to pay attention to it, but I don't give it much weight. I'll put it that way. I'll give you a couple inside tidbits that share with your audience that they probably won't hear anybody else, but I have one friend, I can't mention the name, but a true insider. Let's just say he probably sat in Janet Yellen's lap when she was the chairman, and Ben Bernanke before that, and now back with Jay Powell. So not a member of the board of governors, but an insider's insider. And he told me once, he said, nobody takes the dots seriously. The dots are when every member of the FOMC, whether you're a governor, regional reserve bank president, or they're the members on a rotating basis, they put a dot where they think inflation's going to be, interest rates are going to be, growth is going to be, and when. So it's called the dot plot, and you got all these dots in it. He said, we wish we'd never started it. We thought it was a good idea at the time. We wish we'd never started it. Nobody takes it seriously. Nobody inside the Fed takes it seriously. The media talk it up, to no end. But so you can just throw the dots in the garbage. But they don't even take it seriously inside the Fed, number one. Number two, the Fed's now thinking about raising rates in 2023 instead of 2024. The Fed doesn't know what's going to happen this fall. The Fed can't tell me what's going to happen in September. I just told your audience what's going to happen in September, which is inflation is going to cool down and bonds are going to rally. But the Fed doesn't know that. They have the worst forecasting record of any financial institution in the world, with the possible exception of the IMF. But I think the Fed is actually worse. So every year, the Fed gives a one-year forward forecast. So in 2010, they said, here's what's going to happen in 2011. 2011, here's what's going to happen in 2000, and so on. So it's a strip of one-year forward forecasts that they do every year. They have been wrong every single time by orders of magnitude. In other words, if they said growth is going to be 3.2%, and it was 3.1%, I would say, hey, nice going. You guys stuck the landing. That's awesome. Who cares? But they'll go through. They were saying 3.2%. It was like 1.8. And then they say, maybe we got to lower it a little bit. And they go 2.7, and it was like 1.7. I mean, they were just not even close for 10 years in a row. So, and again, you can look this up. It's all available online. They don't talk about it, but I will. And my point is, with a forecasting record like that, why am I supposed to think you know what's going to happen in 2022, 2023, or 2024? You don't. Now they talk about it. I mean, the only central banker who actually knows that none of them know what they're doing, but he does a fabulous job of pretending. He's Mario Draghi when he was head of the ECB. Nobody, I don't know if it's the Italian actor thing, but nobody was better than Mario Draghi at pretending he knew what was going on. The only central banker who actually does know what's going on, she's the best central banker in the world, is Elvira Nabiullina, who's the head of the Central Bank of Russia. She's increased Russia's gold allocation to 20% of total reserves. So you look at Russia's reserve positions, publicly available, just go to the Central Bank of Russia website, is 20% gold. So in round numbers, it's about $500 billion, of which $100 billion is in gold. If you look at the ratio of gold to GDP, and that's, of course, Russia doesn't have as much gold as the United States, but they have 1/4 of the gold that we do, but their economy is only about 1/8 the size. So relative to the size, they have twice as much gold as the United States. So she knows what she's doing. She's about the only one. The rest of them, I mean, Reserve Bank of Australia, the Federal Reserve, Bank of England, ECB, Bank of Japan, they're the worst, but none of them know what they're doing. But they have to sort of keep, protect their fundamental on the job, so they go through all the motions. But the point is, the Fed doesn't know what's going to happen in any of those years, and so, but they felt they had to do something. And because of this inflation narrative that we already talked about, they do they can't actually influence anything but except psychologically. So they were worried not so much that real inflation was coming substantively, but that inflationary expectations would get out of hand. That can become self-fulfilling. If you and I and everyone else actually does believe inflation is coming, we might start to act that way, and actually inflation might come because we're acting that way. That's called the self-fulfilling prophecy. The great Robert K. Merton came up with that phrase in the 1940s. So they were a little bit worried about that. So they felt they had to put on a show. Like, we're going to tell the world that we get it, that we're just as worried about inflation as they are. Maybe we'll raise rates a little sooner, and maybe we'll start a little bit of a taper. But all they were really doing was playing to the audience. They were just letting the audience know that they were kind of concerned about it. But the market just got hit, between the eyes. It was like, oh well, here comes the interest rate hikes, and here comes the taper, and so inflation must be real. So, interest rates soared very briefly. Gold took a nosedive. Stocks went down, and then they went back up again. But most of the action, the damage, I'll say, was in the bond market and the gold market, which is where you would expect it. It lasted about 2 days. It was serious. It was real. Interest rates turned on a dime after kind of going back up to 155, back down to 145, give or take. But then, of course, what about gold? And gold has been in a very funny situation, which is the following. Normally, you say, well, if there's inflation coming, why isn't the price of gold going to the moon? And why on earth would gold prices go up if there were deflation or disinflation? The answer is that you have to look at the yield to maturity on the 10-year Treasury note. That's our benchmark security. A lot of people look at LIBOR, but I'm like, no, if you're making investment decisions, you're buying a house, you're doing capital investing, these are all 5, 10, sometimes 20-year decisions. The 10-year note is the right benchmark for those large long-term investments. Well, that's an alternative place to put money. You can buy gold, you can buy a 10-year Treasury note. So what's been true since last summer, August of 2020, is as the yield to maturity on the 10-year note goes up, gold prices that strengthens the dollar, and gold prices have gone down because the dollar price of gold is just another cross rate, just another cross exchange rate. So a stronger dollar means a lower dollar price for gold. But if the yield to maturity in the 10-year note goes down, because I'm right about disinflation, then that weakens the dollar, and the dollar price of gold goes up because a weaker dollar means a higher dollar price for gold. So curiously, the price of gold is being driven not by inflation in the abstract, but by the strength of the dollar, which is reciprocal to the interest rate on the 10-year Treasury note. So just to kind of wrap it all up with a bow, what's been going on with the 10-year Treasury note? Here's my, you think of this as a game of bridge, or we have a game called pitch, which is like a poor man's bridge. But here's my trump card, which is what's going on with the 10-year Treasury note. The answer is it's going down. It peaked at 1.745% on March 31st. Today it's around 1.475%. That's 30 basis points. That's a big deal in bond land. So the bond market is telling you that inflation is not real. It's real so far, but it's going away. The bond market's looking forward. It's saying the inflation is not sustainable, and therefore the yield to maturity is coming down, which it is. That's a fact, and that should be very bullish for gold prices, notwithstanding last week's gold hit an air pocket for reasons having to do with expectations and a central bank that doesn't know what it's doing. But that's a separate topic.